And good Sunday morning, my colleagues. And I do hope everyone is well on this nice crisp Sunday morning. So I want to pick up here. What happens? How do you get the value of a bond? How do you value a bond or get the price if the interest payments you receive, the coupons, are every 6 months or semi-annual? So if you got $60 a year in coupon bonds, that means you would get $30 every 6 months. Everyone should be clear about that, right? Everybody should be clear about that. And then when your bond matures at the end, you get your $1,000 back at maturity, right? So there's a couple steps we have to go through. And again, Microsoft Excel will make all this very, very simple. We convert the annual coupon payment to a semi-annual payment. So you can see we divide the coupon payment by 2. And then we recognize that if the bond has N years to maturity, it will make 2 to the N coupon payments in N years. That's 2 to the N semi-annual periods, right? So 10 years is 26-month periods. And then we discount each payment by using the semi-annual required return. So we take the required return and we divide it by 2. So these are the 3 rules we all have to know. These are the 3 rules we all have to know. So we'll highlight that. So substituting these 3 changes into equations 6, 5, and 6, you can see we're just doing a substitution. And this is the equation we have to know. Okay, this is a nice closed form equation. And let's go over this a little bit here, all right? So here's the coupon payments, and here's the interest required return, both divided by 2. And you take 1 minus this term here. And here's the 2, you're doubling the compounding period, the coupon periods, right? You double that right there, you see that? Again, here's your required return divided by 2. And then you have on the right side of the positive sign, we have the the present value of a single lump sum divided by 2 here and 2 to the N periods. So this is important. Okay. So here's an example that we did previously. Here's Mills Company. And you can see now they change it. They changed the rules such that you were getting the coupon every 6 months. So here you are getting $30 every 6 months instead of $60 a year. And you could clearly see, even because the required return and the coupon rate haven't changed, it's still going to be at par. If the required return had gone higher, the price of the bond would have gone lower, and vice versa. Okay, so that should be clear to everybody. Right, so as before, because the required return on this bond equals the coupon rate, the bond sells at par. So everyone should know that the bond is at par here. All right, so I want to make sure everyone's clear about that. And of course, you can use your calculator and do this with a calculator here. And once again, Microsoft Excel will make your life very easy. Here's the equation in Microsoft Excel, how they do it. You'll notice they divided the interest payment by 2, and they tell you exactly what they're putting in each cell. Right? So here's the interest payment. And here is the required return and the number of years to maturity. And here is the bond value. Okay. So I believe, let's see if we click on that. No, that'll just give us this. So anyway, here's the equation. B6, B4, B7, B4, B5, B2, and finally 0 because the payments are at the end of the period, okay? So they very conveniently put all the information in just in cells, right? And then they just do cell arithmetic here, okay? You'll notice this is negative because this is what you would be paying if you would have bought that bond. The money would have come out of your pocket, okay? So you should see that. All right. So the price of a bond does not remain fixed at its par value, as we mentioned already, right? This is an important statement. Bond prices move with yields outside. So the price of the bonds often differ from their par values. Some bonds are valued below par, others are valued above par. So a variety of forces in the economy, as well as the passage of time, affect bond values. And the most important thing, as they say, is that bond prices, they move in the opposite directions of the required returns, as we mentioned, right? So that's an important thing to know. So here is the famous statement that everyone should be aware of. When the required return rises, the bond prices fall, and when the required return falls, the bond prices rise. All right, so whenever the required return on a bond differs from the bond's coupon rate, the bond's price will differ from its par value. So they go through that all again, right? So economic conditions have changed, and there was a shift in the cost of funds or the bond's issuer's risk. So, you know, the company could have a higher risk too, and that could force you to require a higher return, right? So that's an important consideration that one has to know. So increases in the cost of funds or in risk will raise the required return, and decreases in the cost of funds or in risk will lower the required return. All right, so that's, you know, these are important statements. So if the bond is priced below par, it's trading at a discount. And if it's trading above par, it's at a premium. So if we click on premium, the amount by which a bond sells above its par value. And if I click on discount, the amount by which a bond sells below its par value. All right, so let's look at this example again. And just to go through this example, here's 3 bonds. And you notice this bond was at par. So you'll notice par was 6 and the required return was 6, right? So this has not moved from its par value. Here the bond is at a discount, so it's below par, and you can see the required return is higher. And here the required return is lower, and here's the bond value at a premium, okay? So this is a good thing to know about. So you can use your calculator and take these numbers and plug them into your calculator or Excel, and you'll notice that these will, the answers will come out for you. If you have any trouble, just, simply email me and we can go through the calculation in Microsoft Excel. So here's the graph that shows as return goes up, you notice the price of the bond. If you follow this graph right here, the price of the bond is going down. Okay, so this is an important graph to know about. This is called a convex curve. Notice it's not linear, right? It's convex. So here you are at your required return is at 6, and you go up and you're at par. Here you are at 4 and you're at a premium, and here you are at 8 and you are at a discount. All right, so here's some calculator. You could go over this calculator stuff, and you'll notice they do it here for you. Here's the inputs. Everyone see that? So here it is at a discount. Here it is at a premium. They put the inputs in for you right there. And they solve each one in turn for you in the spreadsheet. Again, here's the bond value at a discount, and here it is as a par. So it agrees with the calculator very nicely. So you have good agreement with the calculator. All right, I'm going to play this little video. I hope you can hear it. I have to lower the volume because it's early in the morning here, okay, and I don't want to wake people up.
A bond's price is determined primarily by two things: the cash flows that it pays and the required return that the market establishes for the bond. According to the bond valuation equation, the bond's price equals the present value of the bond's interest payments plus the present value of the principal repayment due at the end of the bond's life. When the interest rate used to calculate a bond's interest payments, which is called the coupon rate, and the market's required return are equal, the bond will sell at par value, which for most bonds is $1,000. For example, consider the Mills Company bond, which promises to pay a 6% coupon rate for the next 10 years. You've already seen that if the market's required return on this bond is 6%, the bond will sell for $1,000. Its par value. Usually, when a bond is first issued, the coupon rate is set to match the market's required return, so the bond will sell for par value. However, in most cases, once a bond is issued, its coupon rate remains fixed, while the market's required return can change at any time. When market required rates of return change, bond prices would change too. Consider what would happen if the market's required return were 8% instead of 6%. The Mills bond becomes relatively unattractive given its 6% coupon rate. Investors will sell it, driving down its price. Using the equation, we can discount each payment, interest payments and principal repayment, that the bond makes over the next 10 years at a rate of 8%, and find that the bond's price drops to $865.80. This is a discount price since it's below the bond's par value. Alternatively, if investors want a 4% return on bonds like this one, then the Mills Company bond is particularly appealing due to its 6% coupon rate. Investors will want to buy the bond, and they'll drive the bond's price up. Using the same equation as before, we see that when the market's required return is 4%, the bond's price rises to $1,162.22, which means that it sells at a premium. Don't forget that you can also use a financial calculator or Excel to find the updated bond prices. After solving for the first valuation using the financial calculator, you only need to change the interest rate input and then recompute the present value to find the updated price. In Excel, enter the $1,000 par value and the 6% coupon rate, calculate the $60 annual interest payment, specify the required rate of return and the 10 years before maturity, and then use the present value function to find the price. The negative sign in front of the results indicates that the bond's price is an outflow for an investor looking to buy the bond's cash inflow.
All right, so that's that, and I hope everybody is clear about that. If you have any questions, just let me know. Okay. All right, so whenever the required return is different from the coupon rate, as you know it can be now, the amount of time to maturity will affect the bond price, right? An additional factor is whether required returns are constant or change over the life of the bond. All right, so when the required return is different from the coupon rate and is constant until maturity, the value of the bond will approach its par value as the passage of time brings the bond maturity date closer. Of course, when the required return equals the coupon rate, the bond's value will remain at par until it matures. That forever. It'll flatline. All right. So here's a nice example here, showing a bond that's up on premium, and as it gets closer to maturity, you'll notice it at maturity. It is maturity, right? When it matures. But it slowly decreases with time, right, as it gets closer to maturity, and the same thing holds for a bond at a discount. So they approach this point over time. This is a really nice graph that shows you, and here's a bond at par, right? As I said, it flatlines. Okay, so that's like really good. That's like really good. Okay, so I'm like 15 minutes into this video now, so I think I'll hold off here, and then I'll pick up the next time. Okay. All right, everybody, have a good Sunday.